Let's bring in CNBC contributor Shannon Saccocia now of NewEdge Private Wealth into the conversation. So, Shan, what do you think? You heard Cameron suggest you could get, high single digits, and then Tom Lee is like, "Oh, you're going to do a lot more than that. You can get all the way up to 5,200 on the S&P."
Well, 5,200 is clearly the approach that you get. Probably more rate cuts than Cameron's certainly talking about, probably in the neighborhood of at least 100 basis points of rate cuts. But you also get strong top-line growth, Scott. I think, the challenge here is that everyone's talking about 2024 earnings estimates being, perhaps too optimistic. But I think if you look at those optimistic earnings, they're being driven by the fact that you look at revenue growth expectations. If you look at the next 3 quarters, for instance, we're going from about, a little under 3% to 4.5% plus in an environment where, inflation's well below that. So I think the delivery of top line growth next year in the absence or moderation of inflation, I think is really where you could potentially get that inflection point in terms of delivery of that type of metric on the S&P 500. I think there's still going to be some challenges to that. I think if you look at the economic data that's underlying, notwithstanding what we saw in today's report, we are seeing a slowdown. And Scott, don't forget, if you talk about the opportunities in a sector like industrials, you're really looking for that manufacturing reshoring. You're really looking for that manufacturing renaissance. And I don't know if you've looked at PMIs lately, but we're really not seeing it yet.
So, you're not willing to be more optimistic for next year than you were this? I think, bears or those who've been cautious have been so this year, it turns out, to their own detriment, right? Because the market has obviously had a pretty good year, and more of late, it's balanced out more than it was. So it's kind of hard at this point to nitpick and say, well, I was right to be cautious, because from November 1st to today, you weren't. And I don't mean you specific, I mean the bearish view.
Well, if you think about how we came into this period over the second half of the year, Scott, we've actually been neutral in equities. And the caveat there is that the pullback that you discussed, that August, September, October timeframe, was really based on rate volatility. And so if you believe that the Fed is kind of out of the equation, and you and I have talked about this, and I think we're standing firm on the Fed being, less of a player as we go into the next couple of months. Then you're thinking about what's happening in the bond market, and that bond market volatility is really where you're going to see, perhaps the foundation. Because if you think about multiple expansion and the need for that, yes, there are, we've talked a lot about that top 10 stocks of the S&P 500 and the multiple expansion that they've experienced. There are other parts of the market that have had multiple expansion as well. So to Cameron's point, I think looking at some of the sectors that are underloved and perhaps have been sold off because of the rate environment, that's really where we're seeing it. Those happen to be also rather defensive parts of the market.